Hello and welcome back to Momentum and Value Investing with Statistics and Python, Episode 2. In this episode, we're going to be looking at two more stocks that we picked out using Friday's data from last week. So before we get into these two new stocks, I just want to give you guys an update on some of the stocks that I spoke about in the previous episode. So let's see. QMU, we're up 8%. And I bought some more at $10. Original buy-in price was $8.62. So with that additional 10 shares, we're up 8%. Let's check out Giddy Holdings. This one's kind of been flattening out, but I'm still pretty confident in this one. But we can see that it's starting to look a little overbought. But here we're up 15%, and I'm pretty sure I only bought this one once. Yeah, these are both on the same day. So that one's doing pretty well. And lastly, let's just look at QD. So this one is up 12%, and I got this one for $2.80. I also bought some options contracts. These aren't doing so hot right now. Didn't exactly get the best price, but I'm confident that this stock is going to keep going up. So I'm holding those, and I'm expecting them to pay out. But so yeah, unfortunately, overall in this account, I'm down on QD. And then I'm just going to go into my other account and show you what I have in here. Okay, so here we see DXYN. So I got in here at $438. We're at $494. We're up 14% there. Then on QD, we're up 13%. So that's about it for our previous picks, if you've been following along. Something that was pointed out to me about DXYN is that they have a really high debt to equity ratio. Okay, so the thing to just point out quickly about DXYN, so even though they have a debt to equity ratio of 4.5, so they are looking like a bit of a zombie. You know, we still have that growth, and the interest expense on the quarter was $1.5 million. So, you know, $6 million a year on interest with net sales of $85 million. It doesn't bother me too much, but definitely something that was good to point out. And we can see a bit of a, downtrend here. But overall, long-term debt, in our zero interest rate environments, is not something that's going to make me, turn my back on a company. So yeah, that's it for updates on previous picks. Okay, so Blackstone Minerals. So this is an exploration company for oil and gas. So they deal in the early stages of production. And this is good because they kind of have less risk exposure from kind of what I'm gathering compared to the oil service companies and some of the other people involved. And so let's just look through some of their financials. So we'll see here dividend yield of 7.22%, which is good, but common for energy companies. and market cap of 2 billion. And of course, we are, investing with statistics, so we're looking for nice lines that are going up and are very straight. So coming down into 3 months, starting right at the beginning of the year, which we like to see, stock is on its way up. So moving down here, so yeah, first thing to point out is that big dividend yield, which is nice to see. But then, as we're looking at an oil and gas company, another thing that stands out to me is their debt to equity ratio. So this is, very low. Total debt 147 million on 1.26 billion of assets. This company is essentially debt free. And this is very uncommon in oil and gas. These companies often are completely saddled with debt because during the downturns, it's the only way that they can stay alive. And a lot of them end up becoming real zombie companies. So it's definitely something to watch out for if you're looking to invest, in this sector. So this is looking, interesting and promising so far. Going down into this income section, we'll see net income 214 million. So healthy there, but something that jumps out to me is the free cash flow of 321 million. So this is greater than the net income. So this means that the accrual ratio is negative. So if this is something you're not familiar with, the accrual ratio is net income minus free cash flow divided by total assets. So free cash flow is the amount of money a company makes from their operations minus the cost to keep that operation going. So that's, the cash that's coming into the business in a simple view, as opposed to net income, which is just a, timestamp of revenue minus expenses. So if you have a company that doesn't have really good free cash flow, but maybe they have some net income, you're a lot more likely to lose that net income because, there's not a lot of cash floating around in the business. So having greater free cash flow than net income is always a good sign. So this is from Richard Sloan. He suggests that investors focus too heavily on earnings and not on cash generation. They value the earnings of a high accrual company just as highly as the same earnings of a low accrual company, even though the high accrual company's earnings are more likely to reverse in future years. When future earnings reverse, investors are, quote, surprised and sell off the stock, causing the stock price to decline. Similarly, when a low accrual company's earnings accelerate in the future, they are surprised in a good way. Having that negative accrual ratio kind of just gives us a good signal on the health of the company. Okay. So the next piece that I want to look at just quickly is we can see that in 2020, their revenue was way down, 38 million for 3 months ended June 30th, 2020, and then 163 million for the previous year. And I'm using the last 10Q, not the most recent one, and I'll show you why in a second. So obviously this was a time when the oil market was completely destroyed. And the fact that this company managed to, let's see, where are we? Only lose $8 million in pretty much the worst oil crash in quite a while. That says a lot about the health of this company. And so then we'll fast forward to 3 months ended September 30th, and we have 43 million of revenue. So we went from $38 million to $43 million. So we're coming back. And we even had a positive net income, $23 million of net income. So, for in a boom and bust business like oil and gas, this company is one of the healthiest that I've seen. Not to say that I'm an expert on oil and gas, but I have seen I've seen some bad ones. We'll say that. And then total liability is down quite a bit, about $250 million. And that's all from their credit facility. So, even in a very down year, this company tightened its belt, without much trouble. And the way it was able to do that is if we run over to the statement of cash flows. Okay, so we'll see, so we have net cash provided by operating activities. So this is basically all the money that they got from doing business. So $221 million. And then if we look down here, we'll see that they spent, about $5 million in change on what looks like CapEx, buying properties, additions to properties, yada, yada, yada. But then they also sold properties, netting them $151 million. So this is how they paid off all of that debt. And we'll see that down here. Yeah, repayment under credit facility, $371 million. So, we don't know if this was a favorable sale for them. They could have been backed into a corner. They could, their creditors could have had them, by the neck the way the oil market was. So maybe they were kind of pushed into the situation, but you can just tell this company is very financially healthy. And I think that's about it for what I wanted to go through here. Yeah, and then if we just look at the stock, just briefly, let's see 5 years. So pre-COVID, we were right about around $10, but I mean, we were in a kind of an oil bear market for a while. So this is a little concerning that we're reaching, the pre-COVID level. Kind of what does that mean? But the thing is, since then, just the financial climate in general, with all of the money that's been pumped in, I don't think that really matters. So I wouldn't really put too much stock there. But yeah, I'd say that's it. That's about it here. Wouldn't be looking for a ton of growth. I mean, that would be nice, but this would be definitely something to hold. Very healthy company. And you'll definitely get appreciation plus that, 7% dividend. Okay, so that about does it for Blackstone. So the next company I want to look at is Gannett. So this is a publishing company. They own USA Today Network. So we have a 0.67 price to book value. So this company is trading below book value. So it's very underpriced just to begin with. So 2020 was a really bad year for them. And when we dive into the financials, we'll see that. And I just bring that up now is because on TradingView we're showing $1.52 per share dividend, and at this price of $5.64, that's about a 27% yield. But unfortunately, that's not the case. There is no dividend right now. But when we look at the financials, we'll see that it is very likely that it will return. So let's see. Let's go right to the 10Q because the TradingView data is, is good for an overview, but it looks at the previous year, so it's not the best picture, especially with how tumultuous the times we live in are. Okay, so getting into the financials of Gannett, we can see that the revenue is increasing substantially. So in 9 months ended September 29th, 2019, we had 1.16 billion of total operating revenue. And then for the same period in 2020, we had 2.5 billion in revenue. So, just about 100% growth there from 2019 to 2020. And then looking at these quarters, we see, a similar, an even bigger jump with $814 million of revenue for this last quarter. So we can see that revenue is in a strong uptrend for this company. So this increasing operating revenue is definitely a very good sign that that high dividend is going to return soon. But now let's kind of get into some of the issues with this company. Go over to the balance sheet. So a scary number here is we see that this company is 1.6 billion in long-term debt. So, debt due over a year, they owe 1.6 billion. We do see that they paid off about 20 million from the previous year. So that's definitely a good sign. And even though this is costing them about 200 million in interest, this is not something to worry about. I would worry about too much on a quarterly basis, especially in the free money environment that we exist in right now. So I wouldn't get too scared off there. But this is definitely one of the reasons that this company is kind of hampered down, we could say. Some good news over here, we see current liabilities, pretty big decrease, about $100 million. So that's definitely a good sign. Okay, so just to go through the income statement one more time, we see the huge revenue growth. We do see a huge increase in their operating expenses, so their cost of doing business is definitely high, and we can take a look at the statement of cash flows to get an idea of that. But we do see a good sign here. For this quarter, we went positive over the last year, even though overall for 2020, it was a terrible year, and they lost $465 million, which is definitely one of the reasons this company is down here and they're not paying dividend. But we're definitely seeing a recovery. Yeah, so I just looked over the statement of cash flows. I'm not going to go into this in too much detail, but to summarize with this company, you have a strong core business that was badly damaged by 2020, but with the increasing revenue and seeing net income go positive, it definitely looks like it's on its way to recovery and, not in danger of dying. On the downside, the company is saddled with enormous debt, and, their huge amount of their income is going towards paying down that debt. My expectation is that, there's a lot of pressure on them to bring back the dividend, so I think that once there's enough free cash flow to get that back, that'll definitely give another boost to the stock. But yeah, overall, especially with the, less than 1 price to book value, this is definitely a steal. And kind of similar to BSM, about to trade right around the pre-pandemic level. But I'm not too worried, both because of the, even more free money environment that we're in now, as well as the fact that this business seems to have, really fixed itself and, is growing much more now than it was, pre-pandemic. So yeah, so I'm going to definitely buy some shares today in these companies. Blackstone, yeah, I'll definitely buy some shares in both of these companies. Usually I wouldn't want to get into oil and gas because it's so boom and bust, but Blackstone looks really healthy. So I'm going to pick up some of those shares, and I'll definitely pick up a couple shares of Gannett, and maybe a couple call options since this one's not paying a dividend. I'm not sacrificing anything there. That's about it for these two stocks. And that's all I have for this episode. If you enjoyed the video, please like and subscribe. It really helps the channel out. I'd like to get us up to 1,000 subs. And stay tuned for the next episode. I'm going to look to post it on Friday. And we'll be looking at some pharma companies and also an interesting patent business. So stay tuned for that. Stay bargain hunting, and I'll see you in the next video.